Let's begin, if we may, with your new ad campaign.
Reestablished?
Yes.
Right.
It's unusual for a company as big as yours to say effectively, we screwed up on national television. Why draw attention to yourself, attention to your mistakes, let's say, by admitting that you lost your customers' trust instead of just moving on?
Well, because we're telling the truth. I mean, I think we've been very clear, and it's not the first time that we've made those statements on national TV. I've been interviewed by you, and we've talked about it,
but
which
not
has been great.
An ad campaign.
No, that's right. But I think it's us, right? It's being honest about saying, look, we made some mistakes. There's no question about that. We've taken responsibility. We're not perfect, but we're going to move forward because there's a great history of this company. We've done a lot of really terrific things, which we talk about in the ad. And then we focus on what we're doing for our customers today, which is a lot about innovation.
The reason I ask why is because if I think back to recent history, for example, the financial crisis, there were lots of banks, probably too many to count, that made mistakes that contributed to the financial crisis, but I can't think of a single one. Not Bank of America, not Citigroup, not other companies like AIG, that ran an ad campaign to apologize, to atone for their role. Why is this different?
Well, I think that again, I don't want to speak for other companies, but what I will do is speak for Wells Fargo.
Speak to your decision making.
Yeah, absolutely. I think as we looked at the feedback that we were getting from our stakeholders, they wanted to hear us take responsibility. So we're listening to our customers, our team members, all of our stakeholders, and I think listening is a really good lesson that we've learned over the last couple of years. So that's just us.
Tim, they say trust in financial services is hard won and easily lost.
Yep.
How do you rebuild trust with these customers while there are still some ongoing issues, like the one we found out about last week, for example?
Well, the issue that was covered last week related to business banking had nothing to do with customers. Those were internal bank documents, and there was no customer impact or customer harm. But the way we think about rebuilding trust is simple. First, I view it as my #1 responsibility. So how do we go about doing that? Other than listening, as we were talking about, it's making sure that we make things right for our customers. It's not only about making sure that any customer is harmed or was harmed is remediated, which we're doing in our retail banking business, in our mortgage business, our auto insurance business. It's also about providing the right information for our customers to manage their financial situation in an appropriate way. I think about the fact that I think we have the most favorable, the most customer-friendly overdraft policies today in terms of our overdraft rewind and real-time balance alerts for our customers. Secondly, it's about fixing anything that was broken. We've fundamentally changed the organization of the company. We've changed leadership. Go ahead.
No.
Yeah.
I was just listening to what you were saying and thinking to myself, if you're right and you have fundamentally changed the culture of the company and the way it does business, then what we learned about last week, altering some client information without the client's permission, surely has to worry you, because that seems cultural, doesn't it? It's not all that far away from creating phony accounts or signing people up to auto insurance that they didn't need or charging them improper mortgage fees.
Sure.
It seems to suggest that there's still a cultural problem. That's why I asked the question.
Well, again, I want to reinforce that we're changing and improving our culture. I think fundamentally the culture of this company is fine. We've got a vision of satisfying our customers' financial needs and helping them to succeed financially that our team members believe in. We have 5 primary values that drive this company. But it's interesting, Eric, because if you go out and Google, right, the word culture, right, in 0.45 seconds, you'll get 90 million references or 40. Everybody's got a different definition. When I think about the culture of this company, our vision, our values, it's absolutely fine. The issues that we have in this company is how we are operating, the policies, the procedures, procedures to accomplish our goals. That's where we need to make improvements. And when I mentioned about fixing things that were broken, those are the things that we're fixing. And we're making a lot of progress in terms of addressing those issues. Because when you think about the situation last week, which is fair to bring up, by the way, right, the difference is that that was discovered because a team member raised their hand, and we've been reinforcing to our team that, look, if you see something that's problematic, raise your hand. That's what happened. It got escalated independently of the business. The business then looked into it with our risk partners. We stopped the inappropriate activity, and we're moving on. If you compare that to where we were a year, 2, 3 years ago, that wouldn't have happened.
So would you say that if any other bank, certainly any other bank of your size, were to do the same thing, were to undergo the same kind of self-examination and encourage the same kind of self-reporting, we'd be hearing similar things out of them to what we're hearing from you?
Well, again, I don't want to comment on behalf of our competitors because they're well-run and they're good firms and the like. But I think any time you have tens of millions of customers, you provide lots of products, you have people everywhere, there's a chance that something could go wrong. Could it happen for them? Absolutely. But I'm focused on Wells Fargo.
Tim, I don't need to remind you, but I'm going to, that an enormous gap has opened up between the performance of your stock since September of 2016, when the first of these scandals erupted, to today, if you compare it with other large banks. And I don't need to name them. I could if you wanted me to, but I'm not going to bother. How long do you think, given all the steps that you're undertaking, it's going to take to close that gap?
Well, hopefully not too much longer. Right? When I look at our financial performance in the midst of one of the most difficult periods in our history, I'm really proud of what our team has done. We're one of the few companies in this country that's made more than $21 billion in the last 5 years. When you look at our metrics in terms of return on assets and return on equity, they're all industry leading, but you're absolutely right. Our stock has not performed as well as we like. I personally think that it's undervalued, and we are very focused, as we talked about in our Investor Day a couple weeks ago, about moving this company forward, but not just to make sure that we've got good returns, right? That's a result of providing good customer service, having the highest team member engagement, making sure that we're very innovative, that we manage our risks appropriately, improve how we manage risk.
Clearly, it's going to be up to the investors to decide when they let you out of the penalty box.
Sure.
But another thing, of course, they have on their minds.
Well, in the last month, we've been the best performing large bank stock.
So would you say the stock has made the turn?
I hope so.
Of course you hope so. I would hope so if I were you.
Yeah. But again, I don't worry about, and this is going to maybe sound heretical, but I don't worry about what our stock does today or tomorrow. What I think about at Wells Fargo is where we're going to be 2 years from now, 5 years from now, 10 years from now. That's where you've got to be focused. So if it means that we need to go through a difficult period to make the right investments so that our earnings are a little bit lower than maybe they could be, I'm happy to make that investment. That's the right thing to do.
Tim, one of the things investors have on their mind is this relatively unprecedented step the Federal Reserve took back in February, putting a cap on your balance sheet. In retrospect, should you have done some things differently? Should you have been more solicitous with regulators? Should you have been more aggressive in making changes on the board? Might the Fed have reacted less harshly had you done those things?
Well, I can't speak for the Fed, but what I can say is there are lots of things, Eric, that I wish we would have done differently over the last few years. But over the last couple of years, I think the changes that we're making in the company to make sure that customers are taken care of, that we're fixing anything that was broken, and that we're building a better company by making these good long-term decisions, that we're absolutely going in the right direction.
You've taken pains to explain to your investors and to others how this asset cap is going to function, the impact it's going to have on your business. One thing that doesn't seem as clear perhaps as some others is the degree to which it has forced you to change any of your plans or any of your strategic initiatives in terms of slowing them down, getting rid of them entirely, or modifying them to accommodate what the Fed has asked of you.
Sure. The reason that we have an asset cap in place is because that we could have and should have managed some of our risks, not all of our risks, better, particularly as it relates to operational risk and compliance risk. We are very focused on making sure that we are best in class in terms of how we manage risk. That's one of our 6 goals. Having said that, the impact in terms of the asset cap affects a small number of customers in our financial institutions group. Beyond that, there's not an impact in terms of how we're going about serving our customers.
In other words, besides dumping those deposits to create room for the rest of the business to grow, there's no impact on anything that Wells Fargo is trying to do?
Not in terms of customer activity, but in terms of making sure that we're making the right investments, hiring the right people, and fundamentally changing how we manage some of our risk. Those are the things that are different, right? And that's where we're very focused so that we can meet and exceed any of the expectations of our regulators.
Are your competitors being as cutthroat as you would have expected them to be if now that they think Wells Fargo has one hand tied behind its back?
You know what? We don't have one hand tied behind our back because when you think about the impact that some of these regulatory challenges have on our business, it's really not impacting most of our team members in terms of how they're interacting with our customers. Having said that, we're in a competitive business, right? And we've always been in a competitive business, and so my expectation is that that's not really going to change.
It's getting pretty late in the credit cycle. Most people would agree with that. Right. And Wells Fargo has already pulled back in some of the higher yielding loan markets, like autos, for example. How conservative, Tim, would you say your approach is to extending credit right now?
Sure. I would say that it really hasn't changed a whole lot. I've been at this company for 30 years plus. It'll be 31 in August. I've been through a number of cycles while I've been here at the company. I think that's one of the hallmarks of Wells Fargo's success is how we manage credit. We tend to be more conservative than many of our competitors. I think that's one of the reasons that we're here. As you were mentioning, during the financial crisis, we weren't one of the banks that created some of the concerns that occurred in the industry. There are some markets that we're a little bit concerned about. Auto, you mentioned, we pulled back. I think we've pulled back enough, and now we're going to be growing that business again. But we have thousands of people. Pardon me?
Where else?
Well, we're a bit concerned about some of the commercial real estate activity. Again, we're the largest commercial real estate lender in this country. We love that business, but there are some transactions that are being done today that just seem a little
frothy?
A little bit frothy, right? And again, I don't think anybody's smart enough, and I know I'm not smart enough to pick the point that credit turns, but you've got to be consistent in terms of how you manage credit, and you've got to be looking for signals.
What are you keeping a close eye on to know when that cycle has turned? Well,
first and foremost, it's what is the fundamental economic health of this country. I mean, most of our business is here in the U.S. So are we growing from a GDP standpoint? Are we creating jobs? But even in that environment, there's a lot of dislocation that's occurring because of technology and for other reasons that can impact our customers.
To that point, there's a lot of concern out there that the yield curve may invert as the Fed raises short-term interest rates. Concern because in the past it has presaged a recession. Do you share that concern?
Well, it certainly could invert. I don't think it would be, if it inverted in the short term over the next year or two, it would be because there was a concern necessarily about us having a recession next year or the year after that. I think it has much more to do with the fact that if you look around the world, long-term rates in Europe and Japan in particular are much lower than they are here in the U.S. You could argue whether or not that makes sense from a risk-return standpoint. And I think that's what's keeping a ceiling on longer-term rates. So you've seen the yield curve flatten out just a little bit.
But if that happens, the ceiling is?
Pardon me?
If the 10-year Treasury is at about 3.1% today, where do you figure it peaks?
I'm not smart enough to know, Eric. I mean, I've heard people say 3.5.
You're risk managing your balance sheet with that in mind.
We have great people at this company that are thinking about that all the time. Could I imagine us seeing a 10-year at 3.5% or 4% sometime in the next 6 to 12 months? Absolutely. I mean, we've had a pretty significant backup of almost 50 basis points just in the last few months. And if you believe that economic activity, not only in the U.S. but around the world, is going to continue to increase, and you could imagine rates getting in that range.
Now, as rates get higher and the yield curve slopes more positively, better for the bank.
It can be, as long as the underlying economy is performing well, right? So from our perspective, a positively sloped yield curve and slightly higher rates are good for the company, they're good for the industry, as long as underlying economic activity is still strong.
Now, what would happen if we did find ourselves in a bond bear market, let's call it, and yields were to rise rapidly past that 350, past 4, toward 5? What would that signal to you?
Well, I think if the pace of that increase was pretty quick, I think that could be negative for the underlying economy, and you could see a slowdown in economic growth, right? That's what I would be concerned about. It's the pace of the increase as much as the absolute yield.
Tim, you've outlined plans to cut some $4 billion of costs by the end of 2019 and even more the following year. And you're already about $1 billion of the way through, is that right? How can you eliminate so much spending while at the same time maintaining a high level of customer care and manage risk?
Because our expenses are too high to begin with. We're starting with a base that's just too high for the company. Now, having said that, we're investing tens of billions of dollars on behalf of our customers every day in terms of improving risk management, in terms of technology and data and cybersecurity and the like. But the fact of the matter is our expenses are just too high, and we're going to bring them down. We're going to bring them down in a thoughtful way so that we can meet the expectations of our customers as well as our regulators.
I'm going to ask what is going to sound like an obnoxious question. Why is it that banks always seem to find a way to cut costs when they need to, when they're under pressure to deliver returns, as opposed to when times are good and revenue's growing? Well, and they don't face things like a cap on assets.
So let me push back and give you an obnoxious answer. And that is, if you look at the historical performance of Wells Fargo, when our financial performance was really good, revenues were growing, we were making acquisitions, our efficiency ratio was the best in the industry. What's happened over the last few years is because of some of the sales practices related issues, because of the pace of the investment in our underlying infrastructure that I was mentioning, our expenses have just gotten a little bit too high, and we're dealing with that.
You've outlined in the course of your presentations to investors what that's going to mean for the branch network. And some of it has to do with the technological advances that you're making internally and the technologies that you're bringing in from elsewhere. You're going from a branch footprint of about 5,800 to something in the order of 5,000 in a couple of years.
Yeah, over the next few years, that's correct.
What's going to happen to the headcount? You've got some 266,000 team members. Yeah. Is there going to be a commensurate reduction in the number of people you employ here?
Well, it depends. I mean, we have tens of thousands of jobs that are available in Wells Fargo today, right, that are open. But there's no question that as we reduce our expenses, there's going to be an impact on the number of team members that work at Wells Fargo. So far, in terms of our branch reductions, there really hasn't been a big increase because most of those branch reductions have been branches that are near one another, and so we've been able to retain about 99% of that team member base.
If we were to straight line it, you take out 7% of expenses, roughly speaking, from where you started. Out of 266,000 employees, you're talking about 18,000 people. Is that roughly?
No, I wouldn't look at it that way because a dollar of expense reduction doesn't mean a commensurate reduction in the number of team members. I mean, for example, we have expenses that are related to investing in technology that have much more to do with underlying systems than necessarily with people, or we have a lot of professional fees or consultants that we use to help us out when we make those changes. So it's not going to be a one-for-one reduction.
Tim, people are going to look back on all the stuff that you've done since you became CEO about 18 months ago and ask one question, because this is really what's on their mind. How far along are you? You identified coming into this job and over the course of becoming CEO all of the things you needed to do. You know what that list is. Right. How far along are you at the end? Have you done everything you need to do?
No, I don't think.
I mean, I know it's constant effort. But in terms of things that you need to accomplish and change, How far along are you?
Well, I think in terms of looking internally and fixing everything that needs to be fixed, turning over every stone, opening every drawer, we're very far along and almost completed with that work. But as you and I have talked about in the past, and I think it's a really important point, and that is one of the learnings that we take out of the last couple of years, and that is no matter how well you're performing, you've got to continue to raise the bar on yourself. You can't expect third parties to do that for you. You've got to do it. So I don't ever want to rest and say, you know what, we've accomplished everything, we're done. It's like the guy that ran the patent office in 1909 that said everything that's ever going to be invented has been invented, right? That's just silly, right? We need to make more progress, and we need to make more progress because that's what our customers are telling us. Their expectations are so high today, whether it's a consumer customer, a wealth customer, or a wholesale customer. They expect the best, and we've got to continue to raise the bar on ourselves so we are the best.